In insurance and reinsurance, asset management plays a strategic role that goes far beyond managing investments. It supports the entire business model by generating stable income, protecting capital, and ensuring the balance sheet can absorb shocks, all of which are essential for underwriting and long-term claim sustainability. Asset management can broadly operate in two ways: as an enabling function or as a value-generating function. As an enabling function, asset management provides investment, risk, and market expertise, allowing insurance business to operate efficiently by ensuring liquidity, capital availability for claims and guarantees, strengthening solvency through disciplined portfolio construction and risk management in close collaboration with actuarial, finance, and risk teams. In a few words, asset management enables the company to deliver on its commitments to policyholders and maintain a strong financial foundation. As a value-generating function, asset management creates financial value for the company by optimizing investment returns within defined risk and capital constraints through disciplined market insights and research, strategic asset allocation, and active portfolio management. Asset management enhances earnings and profitability, supports growth initiatives, contributing to shareholders' value. In a few words, asset management becomes a key driver of financial performance and long-term value creation. Regardless of the nature of the asset management function within the insurance or insurance company, it is essential to build a clear KPI framework. In insurance asset management, having a clear KPI framework isn't just helpful, it is essential. Insurers need to ensure their portfolios stay aligned with the liability structures, regulatory capital requirements, and specific risk tolerance. So there is no such thing like one size fits all when it comes to KPI frameworks. They have to be tailored to the insurer business model and regulatory framework. Life insurers, for example, focus on long-duration liability matching and stable income generation. Non-life insurers typically prioritize liquidity and capital efficiency because their liabilities are shorter term and more volatile. For consolidators, the performance of their asset portfolio is essential in the sustainability of their business model. Regulation plays a major role as well. In Switzerland is SST, in Europe is Solvency II, that shapes how performance, risk, and capital consumption are measured and therefore how KPIs are structured. Despite these differences, most insurers organize their KPI frameworks around three core dimensions: portfolio performance, liability alignment, and capital efficiency. Now, the real challenge comes next, deciding how performance should actually be measured. To measure these dimensions, insurers typically rely on two complementary perspectives: accounting-based KPIs and economic-based KPIs. They serve different purposes, but work best when used together. Accounting-based KPIs focus on financial reporting. Think about book yields, investment income, and realized gains, the metrics that shape earnings and ensure stability in financial statements. Economic-based KPIs take a broader balance sheet view. They look at market value sensitivity, risk-adjusted returns, and the impact on solvency and capital requirements. This perspective is crucial for long-term balance sheet resilience. In day-to-day practice, insurers track multiple KPI categories depending on their objectives. Important is to cascade consistently such KPIs along the asset management value chain. Performance KPIs often include book yield, running yield, total return, all essential for understanding income generation and profitability. Liability alignment metrics are just as important. These can include duration gaps, cash flow matching ratios, and asset liability mismatch indicators. They help determine how well the asset portfolio supports the liabilities. Capital efficiency is a major focus under risk-based regulatory regimes such as Solvency II and SST. Insurers closely monitor risk-adjusted return on capital, solvency capital requirements consumption, and capital-adjusted spreads to understand how each investment affects solvency. These are only examples, but together they illustrate how insurers evaluate performance, liability alignment, and capital efficiency across their portfolios. A solid KPI framework brings all these elements together into a coherent view of portfolio health.